Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the deep dive. Today, we're really zeroing in on the consumer health market.
Yeah. Specifically looking at M&A mergers and acquisitions, right?
Yeah.
For Q1 2025.
Exactly. And we want to pay special attention to what all this activity might mean for the lower middle market.
Right. We're using insights from a pretty detailed industry perspective report. It really helps frame things, especially with the current, economic and political backdrop.
Our mission today really is to cut through the noise, give you a clear, concise take on the trends, the opportunities, especially in that lower middle market segment, without, drowning you in data.
Let's do it. Let's dive right in. Where should we start? The overall landscape.
Yeah, let's start big picture. The report mentions President Trump's reciprocal tariffs announced back in early April. That seems like a pretty big deal. How's that potentially changing the M&A game, particularly for these lower middle market guys?
Well, it's fascinating, actually. These tariffs, especially hitting imports from places like China and India, huge ingredient suppliers, right? It could create this sort of dual effect. On one hand, yeah, maybe it encourages some reshoring, opportunities for domestic manufacturers, maybe smaller ones.
But that takes time and money.
A lot of time and capital investment, exactly. So more immediately, you've got this uncertainty around costs going up, input costs. And that could actually make some smaller players, the ones with maybe less bargaining power with suppliers, it could make them look like, more attractive acquisition targets for bigger companies wanting to lock down their supply chains or just absorb those cost hikes better.
Okay, that makes sense. So long-term reshoring is one thing, but the immediate effect might be more M&A action because of these cost pressures?
Would be, yeah.
The report also said 2024 was kind of slow for deals. What was happening then, and how does that set the stage for maybe the lower middle market in 2025?
Yeah, 2024, it was mostly about really big deals or these smaller bolt-on acquisitions, often from private sellers. The mood was better than 2023, definitely. But the focus was on unique stuff like public companies selling off divisions, big PE investments. Now you add these tariffs into the mix for 2025, plus the general economic uncertainty that's still kind of hanging around.
Right.
You might just see more owners of these, mid-sized, lower middle market companies thinking maybe now's the time to exit. Or, like we said, bigger companies looking to strategically plug gaps.
Interesting. Okay, let's look at some specific public company moves from Q1. Church & Dwight, they're narrowing focus to just 7 power brands. What's the takeaway there for a smaller company?
Well, when a giant like Church & Dwight streamlines like that, it often means non-core brands get divested.
Yeah.
And those brands can be really great opportunities for lower middle market players.
Yeah.
They can give those brands a focus they weren't getting. It shows specialization can work and, good assets might become available.
Then there was USANA Health Sciences buying HIYA Health Products. That's a direct-to-consumer kids supplement company, right? What does that tell us?
Yeah, that one really highlights a couple of things. The value of direct-to-consumer, for one, and also niche expertise. HIYA's laser-focused on kids' nutrition. For the lower middle market, it suggests that if you've built a strong online brand, a strong D2C channel, and you really own a specific niche, you're a very attractive target.
Right, for bigger players wanting that expertise or market access quickly.
Exactly. It's a potential exit route for successful entrepreneurs in that space.
And Glanbia planning to sell SlimFast. That seems like a similar theme. Big company refining its portfolio.
Totally. SlimFast is a big name, obviously, but maybe it just doesn't fit Glanbia's strategy anymore. These kinds of divestitures, they can be gold mines for lower middle market firms or PE funds that specialize in turning brands around.
A chance to grab a known brand.
With potential upside if they manage it right.
Okay, let's pivot to some deals that feel maybe even closer to that lower middle market activity. Bridges Consumer Healthcare buying KT Tape. Why is that one significant?
Right, KT Tape. That's a branded OTC product. Bridges is backed by Charles Bank, a private equity firm. This is kind of a classic lower middle market playbook move.
Building a platform?
Exactly, building a portfolio-related brands. Adding KT Tape broadens their specialty OTC offering. You get synergies, probably, in distribution, marketing, makes the whole Bridges platform stronger, more valuable.
Then Quest Products, another PE-backed company buying Dr. Butler's. Similar idea.
Very similar. Another strategic add-on, this time strengthening Quest's digestive health platform. Dr. Butler's gives them more depth in that specific OTC category. You see this a lot in the lower middle market companies, building scale and market leadership within these defined niches through these kinds of targeted buys.
And Topgum Industries acquiring Island Abbey Nutritionals. That's a VMS CDMO contract manufacturer. That sounds like a supply chain play, especially with tariffs looming.
Oh, absolutely. Topgum makes gummies, right?
Yeah.
Buying a manufacturer like Island Abbey gives them way more control over their production, their supply chain, plus expands their footprint in the U.S.
It seems smart right now.
Yeah, that kind of vertical integration, it could be really valuable with potential cost pressures from tariffs, gives you stability, maybe better margins. We might see more lower middle market companies trying moves like that to de-risk their supply chains.
We also saw Wellful, backed by Kainos Capital, acquire Ancient Nutrition. That feels like a bigger consolidation in the VMS, vitamins, minerals, supplement space. Ancient Nutrition had some big names behind it previously, too.
Yeah, that deal creates a pretty significant independent VMS platform, strong across multiple channels online, retail. It really underscores the continued interest from private equity in rolling up fragmented sectors.
Like the lower middle market parts of VMS.
Exactly, creating larger, more competitive companies. And the fact that Ancient Nutrition had attracted investors like VMG and Hillhouse before just shows the perceived value and, the potential for good returns in this VMS segment.
Okay, let's circle back to those tariffs in a bit more detail. The report, and it draws heavily on insights from Christopher Stradling at Lincoln International here.
All right, he's co-head of consumer there, knows this space inside out.
So Lincoln International's perspective really highlights the potential impact. What are the key things lower middle market players need to grasp about these tariffs?
Well, Chris Stradling and the Lincoln team point out these aren't minor adjustments. You're talking potential rates like 34% on supplement imports from China, 26% from India. That's a big shift from before January 2025.
Wow, okay.
And crucially, these tariffs generally do apply to nutritional supplements, consumer health ingredients. There are exemptions for some things like steel, pharma, but supplements are mostly caught in it.
So it hits the core inputs for many of these companies.
Directly, which obviously could seriously impact cost structures, especially for smaller companies relying heavily on those imports. China was by far the biggest source of imported supplement products in 2024.
So what's the playbook then? If you're a smaller player in this market, how do you navigate this? Lincoln International outlines some steps, right?
Yeah, they lay out a kind of strategic response plan. 4 key things, really. First, assess your risk. You need to know exactly how exposed you are, which countries, which ingredients.
Makes sense.
Second, scenario planning for your supply chain. Think about flexibility. Can you diversify suppliers? Can you dual source critical ingredients? Get alternatives lined up.
Okay. Proactive.
Third, strategic revenue management. That means looking hard at your pricing, but also your product mix. Can you shift focus to higher margin items or items less reliant on tariffed inputs?
And fourth,
optimization and simplification. Maybe that means streamlining your SKU count, getting rid of less profitable products. It also means getting really agile with procurement, finding efficiencies there. These are all vital steps for lower middle market companies trying to manage through this.
All right. So with all this going on the M&A, the tariff pressures, what's the picture for valuations? How are consumer health companies valued right now? And what does that mean for the lower middle market specifically?
Well, the report shows trended valuations for the bigger guys, large cap and mid cap. They seem relatively stable compared to, say, a year ago or the longer term average based on metrics like enterprise value to EBITDA.
Okay.
But valuations in the lower middle market, they're always more, nuanced. It's deal by deal.
Yeah.
However, these big trends, we're talking about strategic acquisitions, the absolute need to manage supply chains because of tariffs, they will influence how lower middle market companies are valued.
How so?
Well, for example, a company in this space that happens to have a really secure domestic supply chain already, or maybe they've built a fantastic direct-to-consumer niche, that company might command a real premium in this environment.
Because they're less exposed or better positioned.
Exactly. As Christopher Stradling and Lincoln International really emphasize, understanding these changing dynamics is just critical for both buyers and sellers operating in the lower middle market right now.
This has been, a really useful deep dive. Lots to think about in the consumer health market. Any final thoughts on what this all means for you, our listeners, interested in this space, especially that lower middle market segment?
I think what's really key, building on those Lincoln insights, is just how much potential there is for both disruption and opportunity in the lower middle market. These tariffs, the shifting consumer demands, they're forcing companies to change, to adapt. That creates space for nimble, innovative companies, maybe smaller ones, to grab market share.
And it also makes for attractive acquisition targets.
Definitely. For those larger players or PE firms looking to build out strategic platforms, there are going to be interesting opportunities.
So here's something to chew on then. Considering this whole tariff landscape, the consumer trends, what kind of innovative strategies could these smaller companies, the ones in the consumer health lower middle market, use to not just, survive, but actually thrive in the next few years?
Yeah, that's the million-dollar question, isn't it?
Think about sourcing, product development, how they reach customers.
It really pushes them to be creative. Maybe it's about exploring hyperlocal sourcing networks they hadn't considered before, or doubling down on product innovation that uses unique ingredients not subject to tariffs, creating a real point of difference. Or maybe it's about building unbreakable direct relationships with their customers, creating loyalty that transcends price points.
That agility could be a real advantage.
It could be. The ability to pivot faster than the big guys. It's definitely going to be fascinating to watch how the lower middle market adapts.
Absolutely. Definitely food for thought. The consumer health market is clearly constantly evolving, and staying on top of these trends, like the ones highlighted in the Lincoln International report, is just essential. Thanks for joining us for this deep dive.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.